about 60 odd points, no great change from when we took that commercial break. Ashu Suyash is Managing Director and Chief Executive Officer at CRISIL, and she's joining us right now on the show. Ma'am, good morning. Great to have you with us here. Thanks very much. Prashant this side. Could you, to begin with, tell us what the budget does for corporate earnings, ma'am, if anything? If not directly, but at a second level or an indirect way, what does it do to corporate earnings?
So, firstly, if I look at it in the backdrop of global uncertainty and the fact that there has been quite a lot of difficulty in revving up domestic growth, the fiscal muscle available to the government was fairly limited. So, I really saw this budget straddling the short term and the long term. And four things stood out, and this would sort of help put into context corporate earnings. One, I think the focus was on unsung India, which is rural poor agriculture. Second, continued focus on fiscal consolidation and going towards fiscal deficit of 3% of GDP into 2020. Third, continued focus on infrastructure spending, especially railways, metros, roads. And fourth, really about looking at more steps to reduce corruption and improve transparency, especially with the use of technology. So in this context, talking about the short term, clearly with the focus on rural housing, roads, you're likely to see much more employment, especially in the areas within rural India and the urban poor. And our own survey, and it's a well-known fact, that nearly 1/4 of the amount that is earned in these segments goes towards discretionary consumption. With consumption having been hit by monetization, along with remonetization, steps like this will go a long way towards improving consumption. And I think unless and until that happens, you're not going to see improved corporate earnings. But the focus on housing will certainly, especially affordable housing, will certainly see the impact on corporate earnings in companies in this segment certainly do well going forward. And from an overall perspective, unless and until you see consumption improving, you're not going to see the push on private capex coming in, especially because after demonetization, our own survey suggests that steel, aluminium, cement, paper, automobiles has really got further hit. And the capacity utilizations in these sectors continues to be very low. So it's very crucial to see some of this play out.
Ma'am, you regularly interact with companies you rate and others as well, large, medium, small, so you have a bird's eye perspective really. What's your sense? I mean, is corporate India, compared to, say, pre-demonetization, is the impact of demonetization now behind when you speak with these companies? Or, as you say, they expect this to continue into financial year 18 as well? And just give us some numbers, if you may, for companies under your coverage. What is your team anticipating in terms of earnings growth?
So first, it's, earnings growth I'll come to in a minute. But I think one of the things that we noticed is credit quality, which is a good indicator in terms of robustness of corporate India generally. If I think about the 9 months of this fiscal, the data is much better. In fact, credit ratio is above 1. And that's better than second half of the previous fiscal. And even debt-weighted credit ratio looks better. And while it's, 9 months data doesn't indicate above 1, at least it's much better than the lows of the second half of last fiscal. And the pointers towards this is the impact on demand on account of demonetization, we see as transitory. It's not something that is permanent. Yes, there was an impact, but I think there are early signs of some of it coming back. Second, especially on the debt-weighted credit ratio side, the fact that commodity prices are certainly better, metals as well as oil, this has certainly helped a lot of companies. In fact, you're seeing the mix on exports also looking better. And this is a good pointer that to that extent, there is a bit of a leg up on corporate earnings related to the sector. And another thing we noticed that corporate India has certainly managed its balance sheet and working capital cycle much better. And just talking to smaller companies on the ground, we found that larger companies really, worked alongside the small companies that were part of their supply chain cycle. And that really, I believe, has helped us really come through this phase. I won't say stronger, but at least we've held out. And to my mind, that's something that augurs well going forward. And, we should see at least some of the sectors supported on account of consumption on a relative basis in next year relative to this year, especially if you take the second half of this year over the first half of next year. I think that will certainly come through, as will the impact of commodity prices.
Okay. Ashu, we just need to take a mandatory break, so we're going to do that, but we're going to continue in conversation with Ashu Suyash of CRISIL. Ma'am, just wanted to actually focus on the banking space because we've seen some amount of green shoots in terms of asset quality recovery, which has taken place this quarter. Do you think that we've bottomed out when it comes to gross NPLs, and your sense on credit growth as well?
I think it's too early to say that gross NPLs have bottomed out. However, what we're seeing is certainly the increase is at a much, much lower pace. And that, I think, itself is a good sign. And I think what really contributes to this is the fact that, you're not seeing enough for corporate India itself to delever its balance sheet. You're also not seeing as much increase in demand for companies to really come out of the challenges they're facing. And at the same time, from an overall perspective, we are seeing that companies are managing their working cycle much better. And those that are in some of the areas that are, have benefited from consumption per se, have begun to do much better. So the way we're looking at it is you probably will still see about a 50 to 100 basis uptick in GNPLs going into next year. Which is much better than the 200-odd basis points increase that you saw this fiscal, which was between, our own forecast this fiscal is between 9 to 9.5 versus 7% of the previous year. And I think one of the things that one must keep in mind is credit growth hasn't been strong. In fact, credit growth this fiscal is around 5% versus 7% of last year. And that itself kind of results in GNPLs not looking really any better. And our own take is that credit offtake generally is not going to be very robust. And that's because private capex is not showing any signs of picking up in the near future. But I would add that on the retail side, retail credit offtake was pretty good this fiscal so far. It will continue to be so, particularly with, the impact of low interest rates, housing, and this budget is going to contribute to that further, especially on the affordable housing side. As well as the fact that agriculture, with the normal monsoon and some of the steps that are being taken on that side, will ensure that consumption certainly improves on that side. So overall, you might see next fiscal credit offtake being a bit better, but really driven by retail rather than corporate.
Okay, fair enough, ma'am. On that note, we're going to wrap up this conversation.